So our first section, section 1, we're going to look at business entity basics. And the reason we're going to do this is because it's somewhat deceptive in terms of deciding whether or not a particular business can qualify, well, if a particular business is appropriately reported on Schedule C. And you can't always tell by simply looking at the type of business. You need to look a little bit more in depth. So we're going to go through and understand some of the legal reasons why these different businesses are organized the way they are. And there may be an opportunity in advising your clients on the tax side to recommend that they, get some legal liability protection on the legal side. And also it's helpful for you to just know how their return should be filed. And you need to understand the underlying business entity to do that. So let's look at entity types first. Number of entity types. We're going to throw these all out here, and each one is pertinent and relevant to Schedule C in some way or another. First, we have corporations. Next, sole proprietorships, partnerships, limited liability companies, limited liability partnerships, and S corporations, and then trusts. Trusts aren't really entities technically, although some of them function similar to an entity, and so it's worthwhile to understand legally their status. So starting with corporations, corporations are really the oldest type of entity. I guess you could say a general partnership is the oldest type of entity, but in terms of an entity where you actually go and file articles of organization or articles of incorporation and create a company, you really start with corporations. And so a lot of the tax law was designed to function in the context of either a corporation or an individual or partnership. So those were kind of the two big areas of the law that evolved. And so partnerships function very similar to the taxation of individuals. There are some distinctions. But generally speaking, the old code was written with corporations and partnerships and sole proprietorships in mind. That's really what the code was designed to do. But there have been some interesting developments in that since that time. So looking just at the legal status, a corporation is something where somebody files articles of incorporation. They generate this separate entity, and corporations legally are separate entities from the partners or the owners of the corporation. They have a separate existence, if you will. Corporations can be born, corporations can die. They die by being dissolved and filing articles of dissolution. Corporations have their own laws. They're called bylaws. That's essentially the underlying structure that runs, that determines how the corporation functions. There's also a lot of statutory guidance when it comes to corporations. Every state has its own corporate law, and wherever the bylaws are silent on a particular issue, chances are the state law deals with that particular issue. And so you have a lot of, essentially, a lot of settled law when it comes to corporations. They've been around for a long time. Sole proprietorships have also been around for a long time. When we say a sole proprietorship, we're essentially talking about a person who engages in business. Now, this takes very, very little to achieve a sole proprietorship. To engage in business, really all you're doing is making a decision in your mind that you're going to start to engage in some business for profit at an individual level, and then take some affirmative step towards that business. That's pretty much all it takes, and then you're a sole proprietorship. You say, hey, I want to start a lemonade stand. My kids just asked me about that yesterday, in fact. We want to set up a lemonade stand. Okay, well, they're already a sole proprietorship, maybe even a partnership. Very simple, very quickly, easily done. You don't have to go to the state to file anything to be a sole proprietorship. There aren't any articles that need to be filed. There isn't anything official. You just open for business and you're a business. That's pretty much the idea behind a sole proprietorship. Now, there are some negative sides to sole proprietorship and some benefits to corporations. The reason people always organize as corporations or incorporated was because there's liability protection associated with that. So legally, if you're a corporation, the corporation does what the corporation does, and then if there are any lawsuits or creditors or anything that arise from the corporation's activities, they can't go after the shareholders to satisfy those judgments. They can only go after the assets of the corporation itself. And to give you an example of what I'm talking about, let's suppose you own McDonald's stock. So you own shares in McDonald's. Well, let's suppose McDonald's does something that is unwise. They sell hot coffee or something along those lines. Or something even crazy, like they start poisoning people because they're too cheap to freeze their meat or something like that. Not saying McDonald's would ever do that or has done that. I'm just saying that's an example, right? So your McDonald's fails to freeze its meat. A whole bunch of people get sick. Some of them go to the hospital. They have hospital bills, and this is millions and millions of people. And they file lawsuits against McDonald's, and they take McDonald's assets. McDonald's has to make claims on its insurance policy to satisfy those. And let's suppose the insurance policy's been maxed out. Now McDonald's is using its assets, selling its buildings to satisfy this judgment, and this enormous judgment. And so all the buildings are now gone. And all the brand equity, they sell their name to somebody and get a chunk of cash, and all that goodwill is now gone and has been expended. Now the question is, if their judgment remains unsatisfied, can they then go after the shareholders? And the answer is no. McDonald's is a corporation. It's a publicly traded corporation. And so you, as a shareholder of McDonald's, you're not assuming any risk of being liable for the actions of McDonald's when you buy shares in that company, because there's a separation between you and the corporation. Now, one thing we need to be clear about, let's suppose you are acting as president of McDonald's, and you made the decision to turn off the refrigerators to save a little bit of money, and your actual actions, your deeds, then generated this liability. Well, then you're not going to be protected from liability under corporate status, because corporate status doesn't protect you from liability for your own deeds. The idea behind corporate status is to protect you from liability for the deeds of the corporation, for the other actors in the corporation besides you if you're the owner. So that's the idea behind a corporation. Now, sole proprietorships do not function that way. So let's suppose McDonald's were a sole proprietorship and you owned it. Well, if, apart from being incredibly wealthy, if the same scenario of uglies happened where all of McDonald's assets had been expended in trying to satisfy a judgment, and you were still left there trying to know what to do with your particular assets, or I'm sorry, if you were left trying to figure out how to satisfy the judgment, and all of the assets of the sole proprietorship were used up, well, they would then go after your assets personally, you, the owner. And that's the way sole proprietorships work. If you don't organize under state law or incorporate and call upon these protections that exist for corporations and for LLCs and S-corps, as we'll discuss in a minute, then you're basically left with unlimited liability. Partnerships really function the same way as sole proprietorships. The difference between a sole proprietorship and a partnership is really just the number of persons engaged in the business. So a partnership, at least, and again, we're talking under legal status here, we're not talking tax necessarily. So for a partnership, you simply have two or more people engaged in a business for profit. And so, once again, general partnerships, it's a legal term, general partnerships under the law do not have liability protection. They're just like sole proprietorships. So general partnerships, sole proprietorships, and corporations used to be all there really was. Then we came up with limited liability companies. Now, limited liability companies were actually invented in Wyoming in the 1970s. And Wyoming, which is not the most populous state or the most engaged in commerce state in the world, although they do a tremendous amount of oil and gas and agriculture, but at the same time, not a real commercial center of, it's not the commercial center of the universe, if you will. In fact, I'm standing in New York City right now, and there are probably more people within 5 city blocks of where I'm standing immediately than live in the entire state of Wyoming. And so not a very populous state. Not a bad place to be. I've been there a few times. But point being, they came out with this concept of limited liability companies. The state of Wyoming did in the 1970s. And the idea behind limited liability companies, it was driven by legal concerns. The idea was that we wanted to have a structure similar to a general partnership, but we wanted to permit that that entity to have limited liability similar to corporations. So you won't necessarily have shareholders and directors in the same structure of a corporation. What you're going to have in an LLC is actually members, and you may have member managers who are both owners and manage the business, or they might be separate. It might be like a corporation where you have separate shareholders from the directors and officers of the corporation. So limited liability companies were designed essentially to permit individuals to have the corporate veil, the protection from liability for the entity's actions, but still function as a partnership for tax reasons. Limited liability partnerships are kind of similar to limited liability companies. They actually came about before limited liability companies. But the LLP is essentially an entity that grants limited liability for the non-active partners and unlimited liability for the active partners. So if you're in an LLP and you're a limited partner, then you do not have exposure to liability based on your ownership in the company. If you're a general partner, on the other hand, you do. So general partners are those who actually manage the day-to-day activities of the business. So if you're a general partner in an LLP, you have unlimited liability. It's just like being a sole proprietor or partner or in a general partnership. So hence general partner. So the improvement on LLPs that LLCs made was that those who manage the business actually are not liable for all the activities of the business. They would just be liable for those activities that they do themselves. So general debts of the business, for instance, they would not be liable for unless they personally guaranteed them. And that would be the same with corporations, sole proprietorships, partnerships, S-corps. That rule's the same no matter what. If you have a bank that's loaning the company money and one of the owners personally guarantees those funds, then regardless of the underlying entity, that person will be liable for that debt. They won't be liable for other debts of the company. It will depend on the actual nature of the entity. So that's LLCs and LLPs. But the purpose of them is to essentially be taxed as a partnership and at the same time have the benefits of the corporate veil. S corporations came about a little bit later. The idea behind an S corporation is that it's a small corporation. Now, small is relative, of course. There isn't a cap on the earnings that an S corporation, that a small corporation can have. There isn't a cap on the assets that an S corporation can hold. In fact, there aren't really anything within the S corporation requirements that suggest that the company has to be quote-unquote small. The only thing small about it is that it's going to have fewer than 100 shareholders. And so that's the only small aspect of S corporations. There are also some sticky rules with S corporations in terms of, well, S corporations are kind of a hybrid because they're taxed as a flow-through entity. So similar partnerships, LLCs, and LLPs are all taxed as flow-through entities along with S corporations, whereas corporations are taxed at 2 levels. And we care about that because corporation being taxed at 2 levels means the corporation itself is treated as a separate entity. It's taxed on its income. And then anything it distributes to the shareholders will be deemed to be a dividend. And it would be subject to tax again. So that's the 2-level taxation concept that exists within corporations. Well, the default rules for sole proprietorships, partnerships, LLCs, and LLPs is that the income and expenses are all flow-through. And so what these entities will do is, if they are an entity and they file a separate return, then they'll generate their return and give the owner a K-1. And the K-1 is essentially going to be the owner's distributive share of all of the entity's activities. And there are a bunch of separately stated items. We're not going to go in great depth into those. But the idea behind the Schedule K-1 is to accomplish the same thing that Schedule C accomplishes for a sole proprietorship. And that essentially is that the individual is going to report that income on their individual return. So these separate returns and flow-through entities will be filed, but the individual will then have to report and pay the income taxes. So then you have, and the difference between corporations, of course, is that these are flow-through entities and they are not double taxed. So then you have trusts, and trusts function in a number of ways. Most trusts these days are grantor trusts, which essentially function like a flow-through, or actually a more appropriate hybrid for that is, a more appropriate comparison would be a disregarded entity. And we'll talk about what disregarded entities are later, but once again, most trusts will have the tax consequences flow through to the settlor or the beneficiaries. So now let's look at the tax significance of these entities. We've been talking a little bit about flow-through versus corporate double taxation concepts. But now I want to look at the specific forms. So what we're doing here is we're saying, okay, here's the entity. What is the default tax regime for this particular entity? And so we start with corporations. Corporations are going to file Form 1120. This is C corporate tax, so this will be your classic double taxation corporate forms. They're going to file Form 1120 if they make any dividends that are made out of earnings and profits, then those dividends are going to be taxable to the shareholders. So if you're in an individual tax practice and you don't do business returns, at least not corporate returns, then your exposure to corporate returns is generally going to just be the dividends forms that they send out to their shareholders. Next you have sole proprietors, and sole proprietors, and this is in terms of the default status, sole proprietors are the only ones that default to Schedule C. A sole proprietor will not file a separate partnership tax return, at least not under the default rules. Sole proprietors, self-employed individuals, these individuals are going to file Form 1040 Schedule C, which is what this course is focused on. And that's really the default status for sole proprietorships. Although that's not where we're going to stop, and we'll talk about why Schedule C becomes important for some of these other entities as well momentarily. Next you have partnerships, limited liability companies, and limited liability partnerships. Now all of these are going to file Form 1065 because all three of these are deemed to be tax partnerships. There are some differences in terms of how how these different types of entities or partnerships are taxed, particularly on the self-employment tax side. But at the end of the day, if you have multiple parties, the default is going to be for you to file a partnership tax return, regardless of whether you're a partnership, LLC, or LLP. Lastly, you have S corporations. Well, not lastly, but that's the last entity, business entity, and they're going to file Form 1120S, and this is a flow-through entity. 1120S is actually a lot more similar to Form 1065 than it is to 1120, but since it's a corporation, they use that form. They use that particular form. Also, if an S corporation loses its S election, and this can happen by violating the rules of who can be a shareholder. You have to have 100 or fewer, although there are some very generous family attribution rules involved in that 100. You also have to have only certain types of shareholders. And so you can blow an S election, and if you're an S corporation filing Form 1120S, you blow your S election, you now become a C corporation by default, and you go back to Form 1120. So anyway, there it is. So there's the form for S corporations. Lastly, you've got the form for trust, and Form 1041, that's going to be your trust income tax return. Again, the majority of trusts are grantor trusts, so they don't actually file separate returns, just whatever activities in the trust are then attributed to the person who created the trust. And that's the way those usually function. So here's our default formats for how all these types of entities are going to be taxed. And these are the default rules. So essentially, Schedule C is only going to apply under the default rules to sole proprietorships and self-employed individuals. And there are a lot of these, of course, because a lot of people engage in self-employment activities, but nonetheless, that's the default rules for these tax entities. So now we're going to look at what are called disregarded entities, or DREs. A disregarded entity, to define it, a disregarded entity is an entity that for tax purposes is not going to be required to file a return. So tax partnerships may or may not be required to file tax returns separate from the owners. And so if you have a tax partnership or an actual entity, so we're probably talking about an LLC in this case, and there's only one owner and they're unincorporated, then it's generally a disregarded entity. So if you have a single owner LLC, single member LLC is what they're actually called, you're going to not have to file a separate tax return for the LLC. And what you would do is treat it as a disregarded entity, and then that single member is going to include all those income and deductions with their own individual tax return, if they're an individual. If they're a corporation, they're going to include it on their corporate tax return. Depends on what type of entity or person they are. But in this class, we're mostly focused on individuals. And so we're going to assume most disregarded entities are disregarded entities who are individuals. Tax partnerships may or may not be required to file tax returns separate from their owners. And if they're a disregarded entity, they do not. Their tax return filing obligation does not exist. You also have a special rule for married individuals that's important for disregarded entities. Married individuals include, clearly, people who are married legally under the law to one another, and if they own a partnership together, so husband, wife, each of them own part of a partnership, well, then they can elect to be a disregarded entity. They're not required to file a separate tax return for the entity. In that case, because if they're married, they're likely filing a joint return. If they file a separate return, then they do have to file on behalf of the entity, because we wouldn't know where to put the income. But as long as they're filing jointly, so you have married individuals who file a joint return, they can then be deemed to have their entity that they own be a disregarded entity. So this means that married people who own an LLC or an LLP or a general partnership do not have to file Form 1065. They can file on Schedule C. So because of disregarded entities, it really opens up a lot more opportunities for filing on Schedule C than would appear to be the case up front. Next question is, what if the number of owners changes? So you have an individual, sole member LLC, and then they sell part of their membership interest to another person. So the membership ownership numbers change. Well, if the number of owners changes, then you're suddenly going to have a filing obligation at the partnership level. And so during the period when it's owned by multiple people, we're assuming they aren't married, multiple unmarried individuals own a business, well, they're then going to have to be filing Form 1065, assuming that's the entity. What if the owner is a corporation? That doesn't matter. Even if you have a corporate owner, you can still have disregarded entities. So if you know, McDonald's, that's the example we've been using so far. If McDonald's owns solely owned LLC, a wholly owned LLC, and there are no other owners besides McDonald's Corporation, then that could be a disregarded entity, and whatever activities happen within that LLC will then be attributed to the corporation. The corporation is going to report those activities on its corporate return. So there's this question of why would an entity exist at all if it's a disregarded for tax purposes? And the reasons for this, there are several, but generally speaking, they're legally based reasons. So if you have a entity that is taxed as a disregarded entity, but for legal purposes it has a separate legal status, that might be important for legal liability protection. For instance, if you own, in our example, if McDonald's Corporation was actually McDonald's sole proprietorship, that would be a problem. And so they might make that entity be an LLC so that they have liability protection on the one hand, but then they'll still file on Schedule C because it's wholly owned, or maybe it's owned by husband and wife. So liability protection is one reason why you would have an entity, even though it's disregarded. That's really the primary reason. There are other reasons, though. You may have regulatory requirements that mandate that you be a separate entity. For instance, sometimes I once had a client and they were a big real estate conglomerate, but they owned an insurance company. And this captive insurance company business had to be a separate entity. So they had a wholly owned subsidiary that was the insurance company. And that was just a regulatory requirement they had to meet, among others, of course. You may have separate imaging, branding, or accounting that you want to keep with this separate entity, and that may be a reason for having a wholly owned subsidiary. You might have separate entity governance and compensation. Instead of it, you might not want this particular segment of your business to be included in your overlying corporation or entity, or so you may have a bunch of different reasons for doing a disregarded entity. So there are a number of non-tax reasons for having a separate company. So it's just worthwhile to understand that these structures may exist. So the next question is, how does the DRE then affect the default tax filing status for these business entities? Well, it does change things a little bit, right? So we're going back now to our entity types, and we've got all the different entity types and the different forms that they're required to file. But now that you have disregarded entities brought into the fray, you suddenly have Schedule C being a lot more prevalent, because partnerships, general partnerships, can file under Schedule C if they're a disregarded entity. Now, if you're one person, you're never a single person general partnership. By definition, you'd be a sole proprietorship. But you may have a husband and wife partnership that gets in the disregarded entity concept. Now, limited liability companies, you have a lot of single member LLCs, you have a lot of husband and wife LLCs, they could be DREs, and as such, they may be filed on Schedule C, and LLPs fall in the same boat. So Schedule C all of a sudden becomes a lot more prevalent because of these different concepts. Now I want to talk about how one other concept within this, and that's the check the box regulations. So these are the default rules for these different types of entities. So we're looking now at the default rules. If you have a disregarded entity, you may have Schedule C getting into the mix for partnerships, LLCs, and LLPs. But now you have something called the check the box regulations, and these allow unincorporated entities to choose their tax filing status, whether it be C Corp, S Corp, or tax partnership. And so the big things to note here are that it's unincorporated, and so basically corporations are not going to be not going to have the check the box regulations apply to them. However, corporations can elect to be either C Corps or S Corps. They do have a flow-through entity status available to them. So when we're talking about the check the box regulations, we're really talking about LLCs, LLPs, and general partnerships. And all of these entities can basically decide to be taxed as a C Corp or decide to be taxed as an S Corp. So it's important to understand that there's this flexibility. And the reason this matters to you and your tax practice is you need to know what they've already elected and whether they can elect to be something different. If you just assume based off the type of entity they are, or based off the type of return that they filed in the past that they're the same, you might be making a mistake. For instance, you may have an entity and part of the ownership interest changed. So it was taxed in the past as a disregarded entity on Schedule C. Well, now that they've brought in a different owner, they may need to file Form 1065. And so it's important to be attuned to the underlying concepts that require your individual to file returns the way they do. A check the box is accomplished by filing an election on Form 8832. And the election is not available to entities that are identified as corporations under state law or that are required to be taxed as corporations under federal law. So required to be taxed as corporations under federal law, that's oftentimes what we're talking about there are entities outside of the United States, so foreign entities. And these foreign entities may or may not, they aren't always called corporation or partnership, and they aren't always called the same types of entities that they are in the United States. So if you have an entity that's required to be taxed as a corporation under federal law, then it's not going to have the check the box regulations available to it. And so that's really the foreign entities discussion. So now if we look at our table, we now have more options available. We've now changed. Partnerships could be a general partnership under the law could be taxed using Form 1065 Schedule C, 1120, or even 1120S. So they get to the 1120s when they use the check the box regulations. And the same thing for LLCs and LLPs. So now I want to look at problem one. Problem one is it's going to take us through and think about, we're going to go through and think about these default rules and apply them in a number of situations. So let's look at the first. So we're going to categorize each of the following entities for tax purposes as a corporation, corporation or possible S corporation, tax partnership, sole proprietorship, and or disregarded entity. And we should consider the S election in these problems, but we're gonna ignore the check the box regulations for purposes of this exercise, just because we get so many answers when you start engaging in check the box maneuvers. So we're just gonna skip those, particularly since we're focused more on individual taxation and Schedule C. Check the box is basically gonna put you from partnership / Schedule C into corporate land. And since we don't really care about that, we're just gonna ignore that for now. So Jose and Maria, husband and wife, are starting a bakery as equal co-owners and do not file anything with the state to organize or incorporate their business. So now the question is, what do we do with that? Well, husband and wife starting a bakery, equal co-owners, so this is a general partnership. And so this is going to be taxable as a tax partnership, or alternatively, taxable as a disregarded entity. Their husband and wife, even though there's two of them, since they're husband and wife, assume they're legally and lawfully married, they are permitted to file either on Form 1065 as a separate partnership, their business activities, or they can file their business activities on Schedule C, Form 1040. And right here, I want to take a moment and talk about why you might choose one or the other. First of all, for convenience and for administrative ease, it might make sense to file on Schedule C and just not worry about filing a separate 1065. And frankly, for a lot of taxpayers, that's going to be the right answer, because if they have to pay for each individual return that they file, they're going to probably want to file just one return. And if we can include the business activities on Schedule C, it just seems administratively easier to do so. And that's a good answer for a lot of businesses. One of the downsides, though, to filing on Schedule C in this situation where they have the option of filing either or, is that when they need to disclose their tax return for their business, it's going to disclose all of their personal information as well. So if you have a taxpayer that's a high wealth individual and the business may be applying for loans down the road, they might not want to be turning over all of their individual information every time the business needs to do something. And so that particular individual may prefer to file on Form 1065, even though they don't have to because they're a disregarded entity. So it depends on the circumstances of the individual, and you'd want to know that, what your client would prefer, and decide whether they want to file on Schedule C or file a separate Form 1065. So there's Jose and Maria. Let's move on to the second problem, the second part of problem one. We've got Buddy and Frank and the company Spelling Incorporated are forming a business as equal co-owners called Love of Reading, Inc. by filing articles of incorporation with their state agency. So clearly under state law, this is a state corporation. This is a corporation under state law. So what is it going to be under federal law? Well, under federal tax law then, this is going to be in the corporate bucket, which means it's either going to be a corporation, or if they file an S election, it can be an S corporation. So that's the answer on that. Next, we're going to look at Corinne, Sherry, Allison, who create a business by filing articles of organization with the state for Brigidaire Limited, a limited partnership that performs electrical engineering. So these three people are creating a limited partnership under state law. So the default rule for a limited partnership under state law is that this would be filing a Form 1065 partnership return. You don't have the disregarded entity status here because Corinne, Sherry, and Allison are three people, and we didn't say anything about their marital status, but even if two of them are married to each other, you're still going to have a third wheel there, and so you're for sure going to need to file a Form 1065 in that case. Let's look at a few different, another example here. I want to look at, this is the last part of this, which is part 4. So we're going to look at James, who's an accounting student who prepares tax returns on the side for family members for a fee. So now we have one individual who's engaging in business on his own. And we're going to ask, what if James does not file anything with the state or make any elections with the IRS? What type of business is this? Well, anytime you see somebody, you have a client who is engaging in business activities who never filed anything with the state, then you know they're either going to be a general partnership or a sole proprietorship. They haven't filed anything. They haven't chosen to be any type of entity, so they get the default entity, which is a horrible type of entity to be, but they get the default entity of being a sole proprietorship or general partnership. In this case, James is alone, so he's going to be a sole proprietorship. So the next thing is, what if after taking a business law class, James decides to organize his tax preparation business into an LLC and files papers with the state to be an LLC? Okay, so we've got his tax practices now an LLC. In this case, you still have a single individual, and so James can continue to file his tax return as if the LLC were a disregarded entity, because he is a single member. Single member manager LLC can be a disregarded entity. So James can continue to file on Schedule C, just like he did when it was a sole proprietorship. Alternatively, he can elect to file Form 1065 if he so wishes. But in terms of the legal status, it's not going to make any difference which tax status he elects in this case. He's still going to be protected from legal liability. So the next step is, what if after taking a business law class, what if after one more year of tax preparation, James converts his LLC into a corporation by filing articles of conversion or articles of incorporation with the state? So now he's just adopted corporate status. If James adopts corporate status under the tax law, he's going to be taxed as a corporation. He's lost his right to be taxed as a disregarded entity. He must file a separate corporate tax return. And he can choose whether he wants to elect to be an S corporation or remain a default C corporation. So there's your entity selection questions. Let's move on to a few review questions now.